In class 11th accountancy, we are on chapter number 10, that is final account with adjustment. Okay, final account with adjustment. We are on this chapter, and yesterday we completed various adjustments like closing stock, outstanding expenses, prepaid expenses, accrued income, unearned income, and last was depreciation. And today we are going to start after these adjustments the new one. So see, in your course you will have adjustments of closing stock, then outstanding expenses, then prepaid expenses, then accrued income, okay, then unearned income and depreciation. See, yesterday you can see these adjustments in yesterday's video. I have uploaded on YouTube. So, closing stock, outstanding expenses, prepaid expenses, accrued income, unearned income, depreciation. All these adjustments we already uploaded on YouTube. So you can check there. Now today we are going to start the next, after this adjustment, that next one is, next adjustment which I want to tell you is bad debts. See, in accounts terminology, already we gave you the meaning of bad debts. But what happened if that bad debts is given in the adjustment? Then it will be termed as further bad debts. Okay? Then it will be termed as further bad debts. Or we can say after new bad debts after adjustment. So what will be the general entry? Bad debts account debit to debtors. Bad debts means those debtors who prove bad. Means the amount irrecoverable from the debtors are termed as bad debts. The amount which is not realized. See, bad debts refer to the amount that the firm has not been able to realize from its debtors. It is regarded as loss and it is termed as bad debts. And the entry is bad debts account debit to debtors account, and C, because this is the bad debts which is irrecoverable and known by the firm at the end of the accounting period, or that's why it is given in the adjustment, that's why it is termed as further bad debts. Entry will be same, bad debts to debtors, but as you know, every adjustment to be shown at two sides. That's why this further bad debts will be shown in two sides of final accounts. One is in the debit of P&L because this is the loss for the business, and another is minus in debtors because now the debtors value is reducing or declining because these persons are not giving the payment. See, two adjustments, two treatments we can say. There are two treatments. One is debit of P&L, another is minus from debtors in the balance sheet. So as you know, every adjustment gives minimum two sides effect, and this is further bad debts that will be shown in the debit side of P&L because this is the loss for the business because debtors are not giving money, and as well as it is to be minus from debtors because it is new bad debts or further bad debts, and the value of debtors is reducing. Now the next is provision for bad and doubtful debts, which you can say PBD, provision for bad and doubtful debts. Now see, every organization prepares some provision for bad and doubtful debts. Because in the business that is possible, if they are selling goods on credit, then it is possible that the few debtors will not give the money. Then in that case, bad and doubtful debts are there. This amount may not be realized in future, and it is not possible to accurately know the amount of such bad debts. So every businessman or every organization keeps some amount or some part of profit as provision. So here the amount of or the part of profit which is kept aside for bad debts is known as provision for bad doubt and bad debts. It is created by debiting profit and loss account because all these provisions are to be created from P&L account. Okay, clear? Profit and loss account debit to provision for doubtful debts. See, yesterday we completed these adjustments and today we are starting after these. So if you have any doubt, you can ask afterwards, but please note down. So profit and loss account debit to provision for doubtful debts, and these are to be shown at the debit side of P&L because provisions are to be shown in the debit side of profit and loss account, and it is to be deducted from the debtors on the asset side of the balance sheet. It is to be deducted from the debtors on the asset side of the balance sheet. Deducted from the debtors, why? Because this provision is to be created for the debtors and for those for the provision for doubtful debts, bad and doubtful debts. See, it is to be shown in the debit side of P&L, and next effect is it is to be subtracted from the debtors in the balance sheet. Clear? So it is to be, see, every adjustment has minimum two sides effect. So same, the impact which you have learned for further bad debts, the same here, but the sequence will be there. First further bad debts, then remaining amount, then provision for bad debts. And the impact in P&L account will be same, debit side, because all the expenses and losses will be shown at the debit side of P&L account. Clear? Now see. Same way. Now next. Provision for discount on debtors. Provision for discount on debtors means every organization keeps some amount of profits as provision for giving discounts to debtors. Okay? To encourage them prompt payment, quick payment, fast payment, early payment before due date. See, if the organization is giving facility of discount on early payment, prompt payment, then everyone will be ready to give the payment immediately. So provision for discount on debtors is allowed to customers for giving the prompt payment. It is also shown at the debit side of profit and loss account, as just now I told you. See, provision for further bad debts, provision for bad and doubtful debts, provision for discount on debtors, all these provisions to be shown at the debit side of P&L account, because these are the part of profit keep aside. So that's why it is to be shown as in the debit side provision for discount on debtors, and you can learn it by PDD. Now the next impact is in the balance sheet. See, that is in the debit side, okay? And the next impact in the balance sheet is by this way. See, subtract from the debtors. Now, my dear children, be careful. All the three items will have same impact in P&L, profit and loss account, and same in the balance sheet as to be subtracted from debtors. But sequence. Be careful about sequence. See, first of all, we should minus further bad debts, new bad debts. Then the amount remaining on that, we have to prepare provision for doubtful debts. And the amount remaining on that, we have to create provision for discount on debtors, which we can say PDD, provision for discount on debtors. Okay, so this is the sequence. First further bad debts, then PD, provision for bad and doubtful debts, then provision for discount on debtors. These are the sequence. Now, next adjustment. Manager's commission. See, manager nowadays, this is a best way of giving incentive, encourage, and motivate the managers to do better by giving some part of profit as commission to them, before charging or after charging. See, if that is before charging commission, then the formula is rate upon 100. And if it is after charging, then the formula will be rate upon 100 plus rate, because that is after charging such commission. The manager of the business is sometimes given the commission on the net profit of the company, and percentage is applied on the profit by two ways: before charging or after charging. If that is before charging, then the formula is net profit into rate upon 100. If formula is after charging, then balance of profit into rate upon 100 plus rate. See, it is given in the question. Then, see, this is after charging, then before charging, then your formula will be, see, before charging, then you will write rate upon 100. If that formula is after charging, see, after charging, then the formula will be different. Rate upon 100 plus rate. Rate upon 100 plus rate. Okay. So where to show? Now the question arises, where to show? Simply, this is the expense for the business, because manager will get, organization will give the commission to manager. So that's why it is to be shown the debit side. Okay, debit side of P&L shows all the expenses and losses of the organization. Then another, this is liability for the organization. See, manager's commission. Why this is liability? Because we are calculating manager's commission after calculation of net profit, and it is the commission on balance of net profit, and it is not paid. And as you know, every adjustment has two sides effect. That's why it is also to be shown on two sides. One is debit of profit and loss account. Another is liability of side of the balance sheet. Okay. C. Debit side of P&L and liability side of the balance sheet. Clear? Got it? Now see. Interest on capital. Sometimes the proprietor may like to know the profit made by the business after providing IUC. So interest is calculated at a given rate on the opening capital. Be careful, on the balance of opening capital, which is to be brought forward from the previous year to the current year in the beginning, and if any additional capital is introduced, brought into the business, then interest also calculated on such amount which is brought into the business. Such interest is treated as expense for the business, yes. As you know, accounts is based on dual entity. Separate entity, we can say, means business and businessman are separate entity, and the amount which is invested by the proprietor in the business is termed as capital, which is internal liability, but that will be treated as liability. So if the organization is paying interest on it, that will be shown on the debit side of profit and loss account, and another impact that should be shown as plus in the capital in the balance sheet. That is to be added in the capital as IOC, interest on capital. Clear? Any doubt? Again, IOD is the opposite of IOC. You should learn it because that will be the part of class 12 in partnership chapter also. See, interest on capital means the capital which is invested by the proprietor is termed as liability, and the business has to give interest on it. That's why it is treated as expense for the business, and this journal entry will be passed in the book interest on capital account debit to capital, because that will be added in the capital in the balance sheet, and it is to be shown at the debit side of P&L account. Okay, now last IOD. IOD means interest on drawings, that is the opposite of IOC. Interest on drawings is the interest charged by the businessman on the drawings of the proprietor, as there is interest on capital is charged on the capital. Same way, interest on drawings is charged on drawings, and the impact will be different. See, interest on capital to be shown at the debit side of the balance sheet, while interest on capital to be shown on the debit side of the P&L account. Save interest on drawings will be shown at the credit side of P&L account. Another change. Interest on capital to be added to the capital, and interest on drawings to be added to drawings. Very good. So today we completed adjustments. And in the adjustments, see, I am making a list for you. These are the adjustments you can see in yesterday's video, and today I am going to tell you about today's adjustments which we discussed today after depreciation, that is bad debts, which is known as further bad debts. Then next, provision for bad and doubtful debts. Provision for bad and doubtful debts means there is the possibility of bad debts. Then provision for discount on debtors. Provision for discount on debtors. All these three will have same impact. Okay, so it's easy for you to learn. The next, provision for discount on creditors, which is the opposite of it. This provision is created on the creditors. Okay, so this is provision for discount on creditors, and impact will be reverse. How reverse? That should be shown at the credit side of P&L account, and it is to be subtracted from the creditors. Very good. Then next, IOC, interest on capital. That is to be on capital, given on capital. Same way, opposite of it is IOD, means the interest charge on discount. And the impact is also reverse. See, interest on capital is to be shown at the debit side of trading account, P&L account, while IOD will be shown at the credit side of P&L account. And next, interest on capital to be added to capital in the balance sheet, while interest on drawings to be added to drawings in the balance sheet. Okay, so IOD. For learning, I am giving you, you can learn by this way. Then last, manager's commission. Now, manager's commission is also of two types, before and after. So, these are the adjustments which will come in your course one by one. Closing stock, outstanding expenses means due, prepaid means paid in advance, accrued means due but not paid, unearned means received in advance, depreciation means reduction in the value of fixed asset. Then further bad debts means bad debts, amount irrecoverable from the debtors. Provision for bad debts means the amount keep aside for bad debts in future, that is provision for bad and doubtful debts, provision for discount on debtors, that provision for discount on creditors. Same here, IOC means interest on capital, IOD interest on drawings. Then manager's commission, that will also include in two parts, before or after. Okay. And maybe there is some adjustments, errors afterwards. Forget to enter, then it to be adjusted, or errors to be adjusted. I am sure you all will be able to understand, and you can write the answers in that way. If you have any doubt regarding this, you can ask.